Today let's discuss about the impending liquidity trap risk exposure in OTM stock options. After hearing the outcry from the trapped put option buyers in Hindalco, there have been enough criticism on the removal of do not exercise choice from the stock option settlement. But until a new notification or circular is out, the gameplay will be the same for this month expiry as well as the expiries here on. Last time it happened in Hindalco, but no stock option is in out of reach from this market scenario. Hence, let's see practically what all measures can be taken to counter the risk created by this situation. Before proceeding further, after multiple reading on this issue, even I'm having doubts on the definition of option. An option is a right but not an obligation. But with this Hindalco mayhem and mandatory physical settlement for ITM options, one can doubt, are options no longer options anymore? But this is a case for a longer debate with a momentary silence to respect all those retail traders who got trapped in the December expiry because of this regulatory change. Let's start. One more thing before we start all this, first and foremost thing to tell you is that nobody cares about the trades you do or calls you take or the money you make or lose. So don't act like the market owes you something after you followed a call or tip provided by the random guru or a registered guru. Once you lose the trade, it is lost. No one else would take care of the situation. All the good and bad belongs to you. I can be a little more civil here, but let this idea sink in. Nobody cares. Nobody. This thought will save you some capital as well as give you a little more insight into better decision making in future. Leaving that aside, let's see what we can practically do to avoid this liquidity trap. We may get in such situation at times because of the play by the other market participants in coming times as well, and it is sorted by the regulators. One generic recommendation before going into stock option trading is treat them and respect them as hedging instruments, not as trading instrument. This will help you make better decisions by avoiding dumb random trades of. With that in mind, let's see what we can do in real trading environment practically. First measure is precautionary. Cautionary trade in stock options. Avoid trading in stock option as soon as the margin requirements by the broker is increased. This usually happens from 7 days before expiry. Nowadays, the most brokers have started to show a reminder, but that is never a fail-proof system. So do not trust merely on the broker's risk management mechanism. This increase in margin requirement can happen for both option buyers and sellers. This is the first sign that it is time to get out of the trade. Second measure is also precautionary. Exit the trade before expiry. Create reminders on every open stock positions on expiry day before 10 to 12 o'clock. You can use Google Schedule, Google Calendar, or any other reminders so that you can close them before this liquidity trap happens. This happens last time it happened in the evening session, but you never know. No matter what, close all the OTM positions, be it on the buy side or sell side. At present, do not even leave your far OTM options to the mere mercy of the market. Close them all. It will not hurt you for closing. Third, measures after getting trapped. Once you know you are trapped, you will need to offset the position based on your open position in the market to come out from that particular trade with limited loss. You can see the table here. It is self-explanatory. So let's look at the what are the possible measures in that 11th hour you can do. From the table you can see that in stock options you can get trapped as option buyer or as an option seller. So if you got trapped as an option buyer in long in the money call option, you can offset the position with long in the money put option, or you can short in the money call option, or you can short the future of the stock. Doing one of the this would nullify your long ITM call position and limit your losses. The choice among these must be done based on the most beneficial and least possible loss basis. This is nothing but a calculation done immediately on a rise of such situation on available choice before choosing the best. We can discuss this method of calculation in another session. If you guys are interested, feel free to comment. Now, if you trapped as a long in the money put buyer, then you have three choices: go with long in the money call, or short in the money put, or buy futures of the particular stock. Doing one among these will offset your risk to limit. If you're trapped as an option seller in short in the money call, then you have to long in the money call, or short in the money put, or long futures. If you got trapped as an option seller in the money put, then the available choices for you are go long in the money put, or short in the money call, or short futures. One of these will offset your risk. I'll link an article explaining the same, and you can see the table and all there. So if you are interested, you can check the link and save the table from there. So if you are a trader, you will know that these countermeasures don't come at the cost of peanuts on expiry day. Hence, the best available choice is not to walk into such situation. But once you are in, these are the remedies possible to avoid larger loss or larger drawdown on capital. For a funny thought, there are groups in social media and messenger apps still providing tips and calls on stock option without having any idea of the impact of physical delivery mandate of in the money on the traders. So use what you hear properly after putting some effort into understanding that proposed trade and how it can impact your account. I have purposely avoided the situation where the option and open on the position of the option is done for hedging, as they don't come under the purview of the topic discussed here.